What's the most common mistake that investors make that actually shows the assumptions of modern portfolio theory do not actually hold much in real life? And when is a mistake truly a mistake? Well, modern finance assumes that when people fear losses, they take on less risks. But in reality, people often take more risks to avoid admitting a loss, and sometimes those risks lead to even bigger losses. This is a classic issue of risk aversion versus loss aversion. So today we're exploring two important distinctions involving both psychology and finance. What is risk aversion? Let's start with traditional finance. In classical economics and modern portfolio theory, humans are assumed to be risk averse. That means, given two choices with the same expected outcome, people prefer the safer option. Try this out yourself. Which one do you prefer below? A guaranteed gain of $100 or a 50% chance to win $200? I'll give you time to think. Okay, time's up. First off, some things should be explained here. The two choices are actually statistically equivalent, and the expected return is both $100, but the first is a guaranteed $100, while the second is a statistical equivalent that says, after playing the game often enough, the average gain is $100 per game. And here, most people choose the guaranteed $100. Theory says investors should avoid unnecessary volatility and maximize returns per unit of risk. So theory says people dislike risk. So far, no problem with modern finance here. But behavioral finance discovers something different. People dislike losses much more than they dislike risk itself. What is loss aversion? Loss aversion emerged from the work of Daniel Kahneman and Amos Tversky in what became known as prospect theory. Their research found that losses hurt psychologically about twice as much as equivalent gains feel good. Losing $100 feels worse than gaining $100 feels good. Not slightly worse, much worse. So gains create moderate happiness, but losses create disproportionately intense pain. Again, try this out yourself. Which one will you choose? A guaranteed loss of $100 or 50% chance to lose $200? I don't know how you answered, but it was found that people choose the 50% chance to lose $200, otherwise nothing, over a sure loss of $100. And that behavior, that's not risk aversion. It's risk seeking in the domain of losses, and it's a hallmark prediction of prospect theory. Did you choose the second riskier option as well? By the way, some explanation is merited here. Both have a mathematical expectation for a loss of $100. The first one is a sure loss of $100. The second one is a loss of $100 if you play this often enough, as before. But since you are in the domain of losses, it's possible you'll stop playing at some point and rack up bigger losses than the expected loss suggests because of your inability to continue and play long enough. We talked about this before in our video about capital adequacy, and the chance of not being able to play long enough can ruin your mathematical expectations. So kindly take a look at the video descriptions below for links to those videos. This means that your average losses will be higher than the expected loss if you're cut from playing long enough because you ran out of money. Anyway, it turns out that risk preferences flip when moving from gains to losses, which goes against the assumption of general risk aversion of investors. So in this sense, modern finance is wrong. And this explains why investors hate selling at a loss, gamblers chase losses, homeowners refuse to sell below purchase price, and traders hold bad positions too long. When this happens, the inclination is to take on more risk than necessary. And this is a mistake. It's a very big mistake as it leads to more losses on average. It's because loss aversion is not just fear of risk. It's fear of realizing defeat. We don't like to lose, even if we can lose everything if we keep on betting. The key distinction. Here's the critical difference. Risk aversion says when outcomes become uncertain, people reduce risk. Loss aversion says When facing losses, people may increase risk to avoid accepting the loss. That's a massive psychological reversal. Under traditional finance, losses should make people more conservative. But under behavioral finance, losses can make people desperate. And desperation often increases risk-taking. So yes, modern finance didn't get the risk aversion assumption correct. But modern finance offers the solution to this behavioral problem. Act rationally when faced with this behavioral bias. And the solution is to have a rule-based plan of action to avoid potentially destructive actions and decisions. The broader picture: modern finance versus behavioral finance. Now imagine this. You have two stocks, X and Y, equally weighted in a carefully selected Markowitz portfolio. One day, stock X starts going up while stock Y starts going down. This continues for a couple of days already, with stock X giving a 20% return and stock Y giving a negative 20% return. Now, which of the following best describes what you want to do next? Please feel free to also comment down below in the comment section so that we can also get a pulse of how you all answered. So, A, do nothing. They're supposed to offset each other. B, sell stock X. C, sell stock Y. Again, I'll give you a few seconds to decide your answer. Okay, time's up. Now let's review your answers, and again, please feel free to comment below what your answer was. So if you answered A, this is consistent with ideas under modern portfolio theory. The portfolio is less risky than either pure X or pure Y alone. So if you answered like this, it might be a rational market argument. If you answered B, you are selling the winner and keeping the loser. If you are doing this because you're waiting for a recovery in Y, this is classic loss aversion, an unwillingness to realize your losses. In the meantime, you might do mental accounting, selling the winner to lock in on gains in your mind while waiting for recovery in Y. This is also called the disposition effect. Now, it's called the disposition effect because investors display a stable disposition, a tendency, or a propensity to dispose or sell winning assets while retaining and not disposing losing assets. The term captures the behavioral regularity observed in trading data and theory. People disproportionately realize gains and defer realizing losses. Now, selling the winner and keeping the loser is the total opposite of what good traders do. This is because you're capping your wins when it could go up some more, while you're letting your losses fly as the stock sinks even more. Whereas good traders will stop their losses but wait till winners hit their targets before they take profits and sell them. Now, if you answer C, you are selling the loser and keeping the winner, so it shows a willingness to stop losses by just realizing losses where they are. Now, back when I was teaching in the university, I immediately knew a person was a trader whenever they answered C, selling the loser, then using the cash to buy more of the winner. The non-traders will normally answer B, selling the winner and keeping the loser in the hope of recovery and avoiding loss. The classic loss avoidance strategy and complete opposite of what good traders do. Context matters. Let's try to avoid some confusion. Okay, now will be the time for some caveats. Just because you answered A, B, or C does not actually mean you're automatically this or that. Context matters. And the same activities given a particular context can be beneficial rather than destructive. And it will be good mentioning them because these are good practices to observe. In particular, we'll talk about 3 specific instances: avoiding losses, portfolio rebalancing, and averaging down. Loss aversion versus loss avoidance. In common speech, people might call themselves loss averse if they sell stock Y, doing C in our case, reasoning that they don't want to be exposed to further losses anymore. This is a non-technical common language sense of loss aversion. In this context, they're correct that since they want to avoid further losses, they are also loss averse. However, we need to make the distinction between this sense of loss aversion with behavioral finance's loss aversion definition. To avoid confusion, let's call the former common language sense, the one that says, I want to stop the losses, as further loss avoidance or just loss avoidance, to differentiate from loss aversion in behavioral finance, which is a technical sense of loss aversion that means a reluctance to admit the loss if they can help it. Here you see that the language context is important. In investments, you see there are stop loss orders that get triggered when prices fall below a set level, at which point the stock is sold. So in this case, the rule-based action is clearly a rational action rather than a behavioral finance condition, and it's meant to avoid further losses. So it's better to think of it as further loss avoidance or simply just stop loss actions rather than loss aversion per se, to make the technical distinction clear. Now, this distinction between rule-based action versus psychologically triggered behavior is generally true and can be made to portfolio decision-making, such as portfolio rebalancing, for example. In our example, the beginning balance was 50-50, so perhaps stock X and Y started at $100, with stock X going up to 120 and stock Y going down to 80. At this point, the weights are now 60-40 rather than 50-50. The investment policy might be to maintain the 50-50 weight to prevent policy drift. In this case, during the periodic rebalancing, which can happen quarterly, for example, stock X will be sold and stock Y will be bought to maintain the target policy balance. In this case, this is not loss aversion, but simple portfolio rebalancing under modern finance, because a set policy was followed rather than merely succumbing to psychological behavior. This is therefore not the disposition effect described before, even though the actual activity is precisely the same. It is the context of the action which is important, it turns out. This might be true because the stocks remain viable for the long term, and the dips in prices might just be market noise. So stock X, even if dropping by 20%, might remain hypothetically viable as a long-term buy and hold investment. Averaging down. While a bit different from portfolio rebalancing, average down means buying stock Y as it dips, especially if it's just market noise rather than any fundamental change in the value of the stock. Sometimes in order to do that, stock X might be sold to buy stock Y. And here, there's no portfolio target weight in mind, but a simple attempt to average down the cost of a purchase. In this case, it's still not loss aversion, as it is not driven by the technical loss aversion definition, but it's an actual attempt to average down costs versus presumably the higher intrinsic value, so that when prices do recover, it will give higher returns. But be careful, however. Sometimes the market might know something you don't know, and that is the reason a stock price is diving calamitously. My trader friends have a saying for that: don't catch a falling knife. Meaning just because a stock you like is going down does not mean you should catch it. You can get hurt a lot, so just let it fall and just pick it up from the floor after it falls. That saying means you wait for the completion of the fall if you still intend to buy it afterwards, but not during. So it turns out having a rational plan that maps out what to do in the face of risk and uncertainty is very helpful in the face of behavioral finance issues and the problems with modern finance. And while modern finance might be incorrect in some of its basic assumptions, it does not mean that modern finance itself or rationality itself have to be abandoned. Understanding these issues of loss aversion versus risk aversion should be helpful to the people who finally decide the governance and management of investments. Or else decision makers might make emotional decisions that override the guardrails within an investment plan. In the end, it still pays to be rational in the face of strong emotional triggers within us all. So in the end, this is not really about modern finance versus behavioral finance. This is about behavioral finance and modern finance complementing each other. That's the pun. And if you find this useful, please like and subscribe to help support the channel. See you next time!